It's good from, the perspective from, the LP side, which I'll put that hat on now, and to set the table for how we think about investing, you got to understand, who we are, right? So we're an insurance company, right? So out of we're an insurance company, but we're a public insurance company in a private market. So if we cover 35% of every worker in New York, that means the private insurers are covering the rest, right? There are, Mass Mutual, Liberty, Hartford. The difference is we're the insurer of last resort, whereas, we can sometimes be 30% of the market or 37% of the market. That's dictating by what the private sector is doing, and they're in and out whether it's based on profitability. So as the insurer of last resort, we don't. So we don't concern about profitability. We're concerned about solvency, right? So we have our goals are paying injured workers, remaining solvent, paying salary and benefits for 2,500 people in New York, and managing capital for 7 or 10 offices, because we're an off-budget state agency. So that's our, sort of. We don't have any participants, right? We're thinking about it through that lens. Also, our lens is that we don't have an actuarial rate. It's a risk-free assumed rate, right? That's sort of our baseline. So then you take the $22 billion, half of it is managed internally by a staff of, I guess, about 15 people, and that's all credit, right? That's to manage our liability. So that's what they do, and they do it very well. We invest in alternatives and bank loans and CLOs and high yield, U.S. equities, private equity, private credit, real estate, and infrastructure through our surplus. And that's all done through external managers. So our perspective is that we have a pacing strategy that we have to maintain. We're not trying to look at, picking and choosing winners. It's about having a diversified portfolio that meets our risk parameters and our return parameters. Those are obviously the things that are issued. We have a view on liquidity is that pay us for it, because we don't have a liquidity issue, right? We write $3 billion a year in premiums. And so we don't have any cash flow issues that some pension plans that may be, 60, 70, maybe 80% where, depending on their structure. So we have this, fairly different perspective, although we do invest in almost all these asset classes. And we tend to, based on our size, can be a lot more bespoke